Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. In case we needed more evidence of how turbulent financial markets have been in recent times, it seems even experienced investors are now turning to financial planners for advice. The global investor study by Schroders, one of Europe's largest independent investment management firms, has found that more than a third of expert or advanced investors say they're more likely to speak to a financial advisor as interest rates rise. Naturally, investment strategies are also changing, with government bonds, digital assets and cash less attractive than they were 6 months ago. Remember, this is general information only and doesn't take into account your own circumstances. You should speak to a professional before making investment decisions. Sam Hallinan is the CEO of Schroders Australia. Sam, welcome to Fear and Greed.
Thanks, Sean. Good to be here.
Were you surprised that so many professional investors, so-called professional investors, are looking for advice from financial planners?
No, I don't think so. The last 12 months have been brutal in terms of investment markets. Interest rates have really played havoc across the board. And I think for people who are investors or who are invested, they realize the power and importance of advice at times when things feel most out of control. So I think it's a case of, if you know the value of advice, you value advice at times when it's most important. So I guess I'm not surprised in many ways, but we've seen this time and time again.
So I suppose it comes to the point, we're big fans of financial advisors on Fear and Greed. And I truly think, even if a third of the professional advisors saying, I need one, then the intermediate group and even the mums and dads who only have passing interest in it, it really does show the value of getting someone who lives and breathes it every day to help you out.
Oh, absolutely. And I think the other thing that this year's study really stood out for me was the link between the importance of financial advice, financial health, and mental health. We saw directly that 64% of Australian investors believe that the performance of their investment has a direct impact on their mental well-being. And I think that's a really important stat. The importance of financial advisors helping people manage the mental aspect of investing, which time and time again is proven to be one of the most important contributors to either people achieving superior long-term performance or seeing behaviour negatively impact their returns.
Okay, so I used to have a DIY super fund, and just the fact that I wasn't doing enough about it worried me. So in the end, I put it into a large industry fund. But it's kind of the same theory, isn't it? Just if you have someone managing your money, you kind of have peace of mind somewhat.
You do. I think there's two things. There's definitely the peace of mind, because you know that you can feel comfortable that someone is looking after this for you. But I think probably more importantly, it's having someone to stop you doing the things you shouldn't at the worst possible time. And we've seen markets come off across 2022, and it is entirely normal, and history has proven to be entirely predictable that people will make poor decisions at the worst possible time. So I think what financial advisors can do during those times of tumult is get their arms around their clients and encourage them to stay the course. And again, history has shown that if you do that, you give yourself the chance of producing superior returns.
How do we get people to see a financial advisor? Because we've seen legislative changes in recent years has not upped the number of people using financial advisors. It's gone the other way. What do we do?
Yeah, look, I think the government has recognised that issue, and their reform inquiry, which Michelle Levy is heading up, is looking at some fairly significant reforms to how financial advice could be provided to Australians. And I think collectively across the industry, everyone is cheering that reform process on. There's been a huge amount of regulation that's been applied to financial advice over the last 15 years for a whole bunch of really sensible reasons, and consumer protections at the core. But I think everyone also acknowledges that has created an environment where it is incredibly expensive for people to seek financial advice, with not many other alternatives available if they don't want full holistic advice. So hopefully these reforms, this review will come up with some recommendations to the government which allow different forms of advice to be provided at different price points, which is all to the goal of making financial advice more accessible.
Stay with me, Sam. We'll be back in a minute. My guest today is Sam Hallinan, CEO of Schroders Australia. Okay, so back to Schroders Global Investor Survey. We are seeing interest rates rise. So, what's that making people do behaviour wise in terms of investing?
Well, I think a couple of different things. First and foremost, when interest rates rise, people's attention turn to the area where they will most be hurt, which is around debt. So what you'll see immediately is people tightening their belts in terms of cash flow, which then does limit the likelihood of them looking to invest. There are corresponding impacts on people's returns. Fixed income returns, which are directly linked to interest rates, have had a big correction in price across 2022. For those companies that are particularly sensitive to interest rate rises, we've seen a lot of those companies come off in value. Technology stocks are a great example of that. We've seen massive declines in tech company values across 2022. All of that has contributed to even diversified portfolios because bonds have come off and equities have come off. Portfolios across the board have come off, which then contributes to how people feel about whether their portfolios are meeting their return expectations. And interestingly, the feedback from the survey is that investors will sometimes make decisions under pressure that they look back on with regret. And I think that is to the point we said earlier. These times will certainly heighten people's concern and likely contribute to decisions that they'd make and in the future likely regret.
One of the findings of the survey is that people are thinking about taking on more risk, and that's in an effort to find yield, in an effort to find better returns. I'm not sure whether that's a good or a bad idea when you have rising interest rates and potential of an economic slowdown to take on more risk.
I think that's probably right. People are saying to us that they're likely to take on more risk because their returns have come off significantly across 2022. Maybe it's that. Maybe it's also a fact of people, particularly those who are more experienced and do have the guidance of financial advice, to recognise a lot of the assets are much cheaper today than they were 12 months ago, and therefore could be a good buying opportunity for good quality companies. So again, it might not be a sensible decision for an individual investor, but important for them to get some guidance as to whether it makes sense for them.
Okay, and are Australians roughly in line with other parts of the world in terms of how they're thinking about risk and investing at the moment?
Yeah, broadly. Yeah, there's not a huge degree of difference from the study that we're seeing in terms of attitudes to risk, what people are expecting to do over the next few years, what they expect to see in terms of returns relative to global. It's interesting, though, if you actually look at what people are expecting over the next 5 years in terms of return, the study is suggesting that people are still expecting returns on average of around 10.4% over the next
Oh,
five
wow.
years, which is a really big number. And it is, I guess, not surprising given that we've seen returns on average over the last 5 years of about 10.7%. So they're extrapolating out what they've seen over the last 5 years and carrying that forward to the next five. But we see some challenges ahead for markets. And as per usual, we're seeing an inherent optimism in what people think that they will achieve over the coming years ahead.
I mean, 10% plus, that would be a fantastic return over the next year or two or three, wouldn't you think?
Yeah, it would be. I mean, we've seen returns in the mid single digits negative across 2022 if you look at the average balance portfolio. So, yeah, the markets would really need to deliver some supernormal growth, taking into consideration 2022 as part of that 5 year period. So, yeah, that would be a big number.
Sam, I mean, the bottom line in this is get some help, get financial advice if you're a mum and dad investor. But just from where you stand, how should people think about markets and opportunities and investing in the next year or two?
Look, I as an organisation that invest for people every day, we are very firmly focused on identifying opportunities, and opportunities present themselves when you see aspects of market volatility. So, I think a very disciplined and considered investor who is capable of either sourcing their own insights or sourcing them from appointed experts like financial advisors or fund managers, we should see some real opportunities for making money over the coming years. But you do need to be very specific as to where you think those opportunities might present themselves. And so I think from our perspective, these market environments do present opportunities to get yourself set for a number of years ahead. And if you are in the right part of the market at the right point in time, which, as I say, typically comes through insight, there are some opportunities for people to generate some good returns over the coming years.
Sam, I have to ask you, whereabouts do you think there are opportunities at the moment?
Well, unsurprisingly, having seen fixed income markets come off to the tune of plus 10% across 2022, we're really starting to see some interest in fixed income, particularly investment grade credit is a part of in the fixed income market that we're seeing some attraction in. So from our perspective, if you were to look at all of the different asset classes, we see some genuine value in fixed income across companies and the stock market. We think there's still a little way to play out with regards to the interest rate increases into 23, which is likely to put some continued pressure on those companies that are sensitive to interest rate rises. So we think there's a little bit more to play out in terms of some market volatility and potential downside risk in the stock market. But then once that gets set, you're going to be buying some good quality companies at some really good multiples. And if you can pick the right parts of the market over this period of time, then you should, as I say, get yourself nicely set for the next few years.
Sam, thank you for talking to Fear and Greed.
Absolute pleasure, Sean. Nice to be here.
That was Sam Hallinan, CEO of Schroders Australia. This is the Fear and Greed Daily Interview. Remember, this is general information only, and you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.